Picture this. You're sitting at your desk, receipts are scattered literally everywhere, the clock is ticking, and tax season is just looming over your head. It's incredibly stressful, right? Absolutely. Welcome to This Explainer. Today, we are transforming how you look at those receipts. We're going to break down the most commonly missed tax write-offs for freelancers and self-employed professionals, focusing specifically on the crucial updates for 2026. Yeah, whether you're a designer in Miami, a consultant in London, or a contractor in Toronto, we are going to set you up to reclaim the money you are legally entitled to. Okay, let's dive straight into this. Last year, the average freelancer overpaid their taxes by over $4,000. Let that sink in for a second. $4,000.
Wait, really? Just by making mistakes?
That is the kicker. They didn't overpay because they cheated or made massive accounting errors. They overpaid simply because nobody told them what they were legally allowed to deduct. They just left money on the table. Today, I'm going to act as your financial friend to make sure you aren't part of that statistic this year. Here is our roadmap for today. First, workspace and tech deductions. Second, vehicles and travel. Third, crucial 2026 tax changes. And finally, number 4, the weirdest legal write-offs the IRS has ever approved. Section 1, workspace and tech deductions. Don't leave money on the table. Let's look at how the home office deduction works. If you use a dedicated space exclusively for work, you have 2 choices. The simplified method is easy. It is $5 per square foot, which maxes out at a $1,500 deduction with zero math. Okay, sounds easy enough. What about the other one? The actual expense method lets you calculate the business percentage of your total home costs. Rent, utilities, you name it. I had no idea. So if I live in a high-rent city, that could be huge. Exactly. For most freelancers, the actual expense method usually results in a much bigger tax break. Your accountant can run both in about 60 seconds, so always check which one actually wins for you. Next up are your everyday expenses. Things like subscriptions and software, online courses, and professional certifications. Wait, what about my co-working space membership? I pay like $500 a month for a desk. Yes, that is $6,000 a year in missed deductions right there. You also cannot forget bank and payment processing fees. Stripe's 2.9% cut adds up incredibly fast. Oh, for sure. What about when a client totally ghosts me on an invoice? Good question. If you track your income when you bill a client, rather than when you're actually paid, which is known as accrual basis accounting, those unpaid invoices can actually be written off as bad debt. Knowing your exact rates is crucial, especially this one if you are in the US. 15.3%.
Ugh, the self-employment tax.
Right. It is painful. It covers both the employer and employee portions of Medicare and Social Security. But here is the incredible news. You can deduct half of that directly from your gross income.
Seriously? So if I paid $6,000 in self-employment tax,
You deduct $3,000 before you even start itemizing other things. Do not skip this step. Moving on to Section 2, vehicles and travel. Deducting your moves. If you are taking clients out, you can deduct 50% of the cost of those business meals. The golden rule here is that it must be directly related to your work. A working lunch while traveling? Yes.
What about my daily sandwich at my home desk?
Absolutely not. Pro tip though. Write on the receipt, jot down who you met with and what you discussed. If you ever get audited, that little note is your proof. Everyday movement pays off too, 72.5 cents. That is the updated 2026 IRS standard mileage rate. Wow, that went up? It did. To give you some context, back when the rate was just 67 cents a mile, driving 3,000 business miles gave you a solid deduction. Now, at 72.5 cents, driving those same 3,000 miles yields a massive $2,010 deduction. $2,010. That is amazing. Just make sure you use an app to track your dates, destinations, and business purposes. Section 3. Crucial 2026 tax changes. New rules, new opportunities. If you are buying a vehicle for your business, you need to look at these 2026 depreciation ceilings. For passenger autos, you can deduct up to $20,300 in the first year with bonus depreciation.
Okay, but look at that bottom row. 100% bonus depreciation for heavy vehicles.
Exactly. The reinstatement of the 100% first-year bonus depreciation for vehicles over 6,000 pounds is huge. You can potentially write off the entire business portion of that vehicle's cost in year 1. Speaking of writing things off entirely, let's talk about the Section 179 deduction. In 2026, the limit has been increased, allowing you to immediately expense up to $2,560,000 in qualifying equipment. 2.5 million? But what does that actually mean for a normal freelancer? It means if you buy a $2,000 laptop, a professional camera, or a specialized desk, you don't have to depreciate it over 5 years. You just deduct the full cost in the exact same year you buy it. There are also big changes to how charitable giving works in 2026. If you itemize your deductions, there is a new 0.5% rule. First, you calculate your adjusted gross income. Then, you find 0.5% of that number. Finally, you can only deduct the charitable gifts that exceed that specific floor.
I had no idea that changed. What if I just take the standard deduction?
Great news there. Starting in 2026, non-itemizers get a brand new deduction allowing you to write off up to $1,000 in cash gifts to public charities. Section 4, the weirdest legal write-offs. Yes, the IRS actually allowed these. Okay, you've made it through the heavy math. Now for my favorite part. I want you to think about this for a second. Can your pet be a tax deduction?
My immediate thought is definitely no way.
But the answer is actually yes. If your animal has a specific, genuine business job, we are talking about a guard dog for your warehouse, a herding dog on a farm, or even a cat that controls the rat population at your place of business.
Wait, really?
Yes. Their food, their vet bills, and their training can all become legitimate tax write-offs because they aren't just family pets, they are working employees. Okay, let's look at this list. A professional bodybuilder's body oil, a tennis professional's sunscreen, landscaping for a home office, and breast augmentation for a stripper? Are these real?
They are legally verified deductions. The IRS allowed the body oil because it was necessary to make muscles glisten under competition lights. Sunscreen is considered protective gear for a tennis pro. If you meet clients at your home office, a portion of the landscaping can be deducted because the property has to look professional.
And the last one?
There's a famous case where a stripper successfully wrote off breast augmentation because the tax court agreed it was a bona fide business expense that directly impacted her income.
All of this brilliantly illustrates the golden rule of tax deductions, summed up perfectly right here. If the intent is business, the cost is likely deductible by the business. What is ordinary and necessary for a bodybuilder is wildly different from what is necessary for a software developer.
So you just have to think creatively about what it takes to run your specific business.
Exactly. And then, most importantly, document your business intent. So, as we wrap up this explainer, I want to leave you with a question. What was your most surprising missed write-off? Was it the software subscriptions, the co-working space, or maybe realizing you could deduct a portion of your home internet? Take 10 minutes today, organize those receipts, and stop leaving your hard-earned money on the table. Start preparing for 2026 right now, and we will see you in the next explainer.